Hello, welcome to the September 29th, 2023 Fed Watch. I'm Brian Beaulieu, CEO and Chief Economist for ITR Economics, and we're going to talk about four distinct things today. There's going to be the PCE core inflation data that came out, and that was favorable. We're going to talk about real personal incomes adjusted for inflation, and that trend is also favorable, which is great. And starting off with two good pieces of information. Third thing we're going to talk about is the money supply. And that's where it's not so great. It really tips the Fed's hand, lays it kind of open for all of us to see. It's going to get very interesting in a couple of months. And finally, we're going to talk about the inverse curve because there's something interesting going on there also. So back to number one, the PCE excluding food and fuel. We saw that inflation rate, which is the Fed's preferred inflation rate, dropped to 3.9%. You probably have already read that by now, and that's encouraging. It's the lowest rate in about 28 months, and it theoretically could provide the Fed with the breathing room it needs to not raise interest rates again this year. They are still all over the map, it seems, depending on which voting president you listen to. Apparently I confused some people last week. Our forecasts show that if the Fed took their hands off the steering wheel, off the interest rate controls, we would achieve their stated goal for inflation of 2.0%. That's where the CPI is going. That's where the PCE, excluding food and fuel, is going. The only thing that continues to hang it up is wages, which brings us to number two. Real wages are still running higher than they were a year ago. Compared to last year, real income, excluding government transfer payments, are up 1.7% from this time last year. And that means for, I think it's the fifth month in a row, 6 months in a row, we have a record high level of income after adjusting for inflation. And that means on average, people out there, if they want it, they can afford it. Inflation isn't hurting them on average. Now, we've talked about this before, where we're living in a bifurcated economy right now. So clearly, the inflation is hurting people. You've been reading those stories, and I've been trying to get across to you that there's the whole other side of the parameter or the equation where disinflation doesn't mean anything to people except for those who want to borrow money. And it is going to matter to some wealthy people if the commercial real estate market continues to unravel in certain sectors. But for now, your average person out there is making more money, and they're going to continue to spend that money. The concern we have is that wage inflation has to slow down. I mean, we've been talking about that in all of our keynotes. With the joblessness going up, with the job openings coming down, with quit rate having come down, we don't need to give the same magnitude of wage increase that we had before. Wages tend to lag behind inflation, as we have talked about before. But I don't think we're going to get ourselves into any real income territory, real income difficulties until we're into 2024, at least in terms of running ahead of year-ago levels. That's the way the numbers look for us. And that's good in terms of keeping retail sales somewhat positive and keeping this economy chugging along, at least in terms of GDP. The third thing I wanted to talk about was the money supply. And that is, I mean, it's running 7.1% below year-ago levels on a monthly basis, and that data is through August. The raw data continues to go down. The 12-12 rate of change is at minus 7.0, which is a record low. But here's the interesting thing. I looked at the trend line, and the money supply now is just about back on trend with where it was tracking pre-COVID. In other words, we're a month or two away, it looks like, from the Fed having erased or drained out all the quantitative easing in terms of the money supply. I think that's important. They never talk about the money supply, but clearly that's been part of the goal. And if we see the money supply drop a little bit below the long-term trend, you're going to see it bite into the economy a little bit more, the money supply negativity bite into the economy a little bit more. And that may be what the Federal Reserve is hoping to see. It's not great for the stock market. It's not great for Main Street, but it is what it is. And the fourth thing I wanted to talk about is the inverse yield curve. We now are within 100 basis points of seeing the inverse yield curve normalize. But just like everything since COVID, it's not normalizing in a typical manner. In fact, we've never seen it normalize this way before. It's normalizing because the long-term bond yield, the 10-year government bond yield, continues to go up as the Fed cleans up its own balance sheet, and as we see people still moving away from the long bond because of the higher interest rates on government agency bonds, et cetera. We're just getting this strange rise in the 10-year government bond yield. We're going to wait until Monday to see if the government closes down and to reevaluate our forecast for the 10-year government bond yield and what that means for the yield curve. On October 2nd, the Econ Thought Leadership team is going to get together, and we're going to try and figure out, okay, does it matter how we get into a normal yield curve, or does it not really matter? Because what matters is the disturbance the irrational behavior causes. So stay tuned. We'll talk about that next week on Friday, and I'm sure we'll have some more to talk about because it sure looks like we're going into a government shutdown. Brief word on that, and I didn't tell you that there were 5 points, is historically it matters more to Washington, it matters more to the stock market than it does to Main Street. It doesn't tend to really freak people out unless you're one of those federal workers who isn't getting paid, and unless you're getting on an airplane and you're going to be subject to even longer lines. But Main Street USA doesn't really care as long as they're getting their checks, and they will continue to get their checks. It's not that big of a deal for the economy, at least in the short term. That's the Fed Watch for this week, September 29th, 2023. Some mixed news to sum it up, but the economy isn't unraveling. We are getting the right direction going on disinflation, and the Fed is playing their money supply trend game very effectively. We'll see where that leads. Thank you for joining us. We'll see you next week.